the topic of this presentation, is shares and how shareholders do things and make money out of using their shares, which I think is a fun part of discussing company law because it has a direct implication on how investors manage to get their money out of being engaged with companies. We have approached things so far from the perspective of the person who's trying to set up a company because they're trying to run their business through a company. So, of course, the incentive of somebody who wants to do this is to benefit from the various things that this vehicle gives you in order to carry out your business effectively. Running it on your own as a sole trader as opposed to running it through a corporate, then running it as a sole trader has less bureaucracy because you actually don't have to do anything at all. Right? So that if what worries you is the paperwork, then just don't do anything and you're fine. Protecting your assets through limited liability is a key motivator to starting a company. And also from an administrative point of view, separating your personal finances, your personal life and money from that of your business is also why people will choose a private limited company, so they can split the two. So these walls that you construct between who you are as an individual and who you are as a business person can come in handy. When it comes to making the money, if your business does generate money, the company structure gives you an opportunity to take that money out of the business and give them to you as a personal benefit, so then you can actually spend it. Because one of the things that it's important to remember is that if you have taken this step to set up a separate company to run your business, and the accounts are separate and the structure is separate, you cannot actually use the company's money for your own personal expenses. So every time you're spending something that comes from the corporate account, you really need to have an explanation as to why this has come from the corporate account. Let's say that I took the tube to come in here today. And then I bought a coffee because I didn't have my card, so I cannot get into my office to make one. Could I have paid this with my company bank card? Well, I don't need, the problem is not so much from a permissions point of view, because the company is just me, there's nobody else. So I don't really need to generate paperwork to authorize myself to take the train. But from a tax compliance point of view, I need to be able to demonstrate that this expense is linked to the business. Because obviously, you as a person have multiple roles. You are, who you are as an individual, you got your private business and your private expenses. So you could have taken the tube to go see a theater play. Or you could have taken the tube in another capacity as an employee of a different business to go to that business. Or you could have done it as part of carrying out the work that is related to your actual private limited company. So for me, taking the tube, taking a coffee or, my lunch would have been fine if I was doing it in my capacity of carrying out business for my company. But if I took the tube to come and teach you guys, this I'm doing in my capacity as a university employee, which is not linked to the company. So this is not a company expense. If I'm paying, can I pay my phone bill out of the company bank account? Well, am I using that number for company business? Because the company is entitled to have equipment, it's entitled to have assets, it's entitled to purchase services. But if it's my private mobile that I use for life in general, then that's not company business. A percentage of it, from a tax compliance perspective, a percentage of the use of a private phone for business is allowed, but then if I needed to claim part of my phone bill through the company, then that would come as a business benefit. So I would need to pay tax on it for receiving that benefit. As an individual, it would be a taxable benefit that I receive from the company. If I want the totality of the phone bill to be paid by the company, then the totality of that phone line needs to be used for the company. So I can have a personal phone number. I would need a separate phone number that then I can say, that's the phone number that belongs to the business. This is how the business can be contacted. Yes, this phone has a monthly bill because it's a kind of pay monthly mobile contract, and that's. So you need to think every time, because it might be one individual that carries out all of these things, but you need to think every time, what role is the individual occupying where carrying out those actions? So again, the benefit or the incentive of running through a company is to help you structure all of these things. So you can have these categories clear in your mind, and you can apportion behavior, expenditure, income, depending on how it comes, whether it belongs in the personal side, it belongs on your employee side, if you're working for somebody else, or whether it belongs in the corporate side, in the various capacities that you've got in there. Well, money laundering is a set of provisions in the law that are trying to prevent money that has not been declared, how it's been earned, is not obvious to the authorities, from making its way through the system. One of the ways in which you could get in trouble for compliance from the money laundering regulation would be if you're not very clear as to how payments are distributed between the various accounts you've got, and whether your account, the private accounts and the business accounts, are not kept distinct. For instance, an easy example as to how you can get in trouble. Say that I do work for somebody that is overseas and they want to pay me in euros because they're over there, right? But my business is a UK business. It has a sterling bank account. It doesn't have a euro bank account. I could, if I wasn't familiar with how these things work, for instance, if I hadn't taken this class, I might think, well, I've got a euro account. What's the problem with this? I'll ask them to pay in my euro account, and then I'll transfer the money from the euro account to the business account, so it makes its way there in sterling. I'll do the transfer myself from one currency to the other. Or I just keep it in the euro account, and then I send from my sterling account to the business the sterling amount, so I don't lose money by trying to change through the bank or something from one currency to the other. Well, the problem here is there's no legal explanation why I received that money in my personal account, because I haven't done anything for them. The company carried out some work, and the company should have been paid. So why did this money come into that bank account? And then when I send from my personal account into the company account, again, there's a question, why am I making this payment? What is the purpose behind this? So if challenged, you need to be able to demonstrate for every incoming or outgoing payment, what is the purpose of that payment? And if it relates to business activity, to have an invoice that is related, or a contract that is related to that business activity. That's how you can defend it to the authorities. Otherwise, you're going to get in trouble. And the money laundering trouble is you breaching the law separately to any tax compliance issues. Also, an additional problem from a company perspective, if we made these payments in this way, is that it would incur personal tax liability twice. Because if I get money as an individual and I declare it to HMRC, I'm going to be taxed on it as personal income. If I then send that money over to the company is going to be taxed on it again as personal income. And when the company tries to send me back that money, perhaps with dividends, as we're going to see, or something else, I'm going to be taxed again. So it would be a really totally inefficient way to transfer money from a tax point of view. So you need to be aware of this, but also because there are no invoices for work done to justify these payments at every single stage, I might get in trouble with the money laundering stuff. That's why if you come from home with your pockets full of cash and you go to the bank to deposit it, after a certain amount, they might ask you, where did you get that money from? So if you withdraw this money from another account, here or overseas, and you can show a receipt or in a kind of booklet that the bank gives you what the transaction has done and where it came from, it's fine, they're happy. But if you say, I had my birthday and all the uncles came and they all shoved a bunch of 50s in my pocket, they might say, no, we cannot accept that money into your bank account because you cannot tell us, give us all your uncle's details that we know where that money came from. You're allowed to receive gifts up to a certain amount. It's tax-free. That's fine. But they will ask you for compliance with the money laundering regulations where that money came from. If you cannot demonstrate where it came from, they will not accept it. If you send it via a bank, they won't ask you any questions because they know where it's coming from. Then it becomes a tax compliance issue as opposed to a money laundering issue. The key problem with the money laundering is cash. Something that is not already present in the banking system. Because normally it's the entry into the bank that needs the proof that it's been controlled and we know where it's coming from. Now, how this works with crypto, it's probably fine in the sense that a crypto transaction will generate a receipt when you redeem the money back into sterling, so you will be able to demonstrate that this is earnings from crypto. If you won it in a casino or through online gambling, that again is going to generate a receipt, so that's fine. What they really don't like is not being able to trace back where the money is coming from. But step one in compliance for any of these controls is for you to be able to distinguish personal from business. If you've taken that step to create that barrier through the establishment of a private company, you then need to be mindful of how this money makes these transfers. If your company runs out of money, you can make a loan to the company, but then again, this will generate a paper trail and you can defend where that money is coming from into the company and for what reason. In kind of previous presentations, we have gone through some of this content, so that should sound familiar. But we haven't talked so much about other people that might be involved in the company that are not you, because there might be other investors involved in the company. Could be that somebody else wants to contribute in what you're doing, or a bunch of people come together in order to do so. Which brings us to a discussion about shares and the way that the shares work and how they operate. Now, we have said already that when you're setting up a private limited company, if you're doing it for profit-making reasons, the most obvious way to do it is to divide ownership of that company in shares. It doesn't need to be many shares, it could just be a single share. Now, my company is set up with one share, which the nominal value of this share is £1. What does it mean to say nominal value? A nominal value of the share is what is specified by the company as the value of the share when it's made available for somebody to purchase. We would say it's written on it, but since they're all immaterial now, it's not technically written on it as in a piece of paper. Back in the day, you used to get a share certificate that would have like £1 written on it. These days, it's all done electronically. But the nominal value, the official value, so far as the company is concerned, of the share will be set at the point of incorporation. So my company had one share, value £1. This doesn't mean that when you buy the share, you will pay £1. You could pay more. For instance, I paid £2 to purchase that £1 share. This has implications that I'm going to explain later on, but it's common. If you are attracting investors, it could be that they pay a lot more money to purchase that typically £1 share, because there's a difference between the nominal value, what's written on it, and the transactional value. If this company has run for a few years and it has got regular turnover and is generating money, obviously, if it had been set up with 10 shares of £1 each, the company is worth a lot more than £10 in total. So if I wanted to sell some of those shares, if I had all of them and I wanted to sell some of them to somebody else, then I would sell them for more than £1. It doesn't mean that the nominal value of the share has changed, but it means that the transactional value of the share now is a lot higher. But when it's transacting, the money doesn't come back to the company, it comes back to the shareholder who's selling them to somebody else. So then it might be that one share is listed as £1 nominal value, but it has sold for £20 to somebody else who really wants to participate in the company. But question number one, in any discussion that has to do with shares and issues of valuation and understanding how shares work, is to figure out whether shares are property rights or are something else. This has caused a degree of confusion both for the general public and the courts. There is a difference in perceiving something as a property right, perceiving something as a contractual right, or perceiving it as something else, as something that generates obligations that come from different fields. property rights are important because within the boundaries of the law, of course, you can do whatever you want with your property. So when somebody is selling something that they own, they can determine the price for their own benefit when they're selling. If you're listing something on eBay, you decide what's the starting price. Or if you have the buy now option, you determine what's the price that you want if somebody wants to buy it. It's your thing. You don't have to think about the interests of the buyer. You don't have to think about the interests of eBay. You don't have to think about any other thing other than your own personal interest when you're trying to dispose of your own property. You owe no consideration to other people. If, however, you were in another position, you were managing something in the form of a trust, for instance, or something where equitable considerations might come in mind, you might have obligations to consider interests of others when you are making decisions. So there's a difference between the shareholders exercising their rights to participate in company management when they vote at the general meeting and selling their shares. Because when they're acting as shareholders in a decision-making capacity, they have an underlying obligation to think about the interests of the company. So yes, they have to be mindful of what the impact of any decision is going to be for themselves, but there is a sort of baseline expectation that when the general meeting is making decisions, they do it with the interests of the company in mind. That's why they are often challenged when they're into a fight with somebody and their intention is to harm the person with which they're in a fight with, as opposed to whether what they're trying to decide is promoting the interests of the company or not, right? So there's a legal constraint in how they make decisions. But when it comes to selling their shares, if we consider the shares to be property rights, they can do whatever they want. So on the selling part, they're free to determine value for themselves. And they don't have to think about the interests of the other shareholders. They don't have to think about the interests of the company more broadly. So this is the consequence of perceiving shares as property rights. Now, this is very complicated because we said at the beginning of a discussion on how you set up a company that the basis of company law are contractual. The shareholders get together in forming a company by structuring the Articles of Association. The Articles of Association work as a contract between each individual shareholder and the company together. So there are contractual elements, there are property law elements, and there are other duties that come in behavior that has to do with the company. Cases like Short and Treasury Commissioners, which is the case from 1948, have tried to kind of navigate this, and they came up with the answer that says, yes, these are property rights. But there are still issues to consider. If you recognize that shares are property rights, what does this actually mean if the company shuts down? They are property rights, but what do they represent in terms of the value of the company? If a company is broken down into 100 shares, does this mean that if we have this company shut down today, if we're winding it up, each shareholder has a 1% claim over the totality of the assets? Is that how it works? The answer is no. So even though the shares are property rights, and you have freedom to determine what you want to do with them and what value represents to you when you're trying to sell those shares, when the company shuts down, it isn't as simple as saying, we take whatever assets are in this company and we divide them by the number of shares, and then each shareholder is entitled exactly that percentage of the company assets. And short is one of the cases where they had to figure this out because the company was shutting down and they got into a fight with the revenue as to what were the taxes that should be paid and what is the value represented by the company and what does this mean for each individual shareholder. So the answer of the court was, yes, they're property rights, but you do not have an exact correspondence. Each share does not automatically give you an equivalent percentage over the totality of the assets that the company has. That it's a more complicated arrangement. So you have to fight at court issues of value, even though it is recognized that the shares themselves are property rights and you've got rights over them in similar ways as you would have over anything else that is your own personal property. Now, I started off by saying that what is technically written on the share in terms of the value is not the real amount that people are transacting with. And I told you that this has consequences. Now we're going to explain what these consequences are. How does the company get money to begin with? A private limited company starts and it doesn't really have anything before the shareholders purchase the bits of the company as they're acquiring those shares. But if the shares are set at a low nominal value, then the company doesn't really attain a great deal of money. So my company was set up with £1, actually 2 because I paid 2. Now, why did I pay 2? Because there's a difference between the nominal value and the transaction value. Both of these elements will come together and form what is called the company's capital. So the company's capital is the value that the investors are putting in, and it contains the nominal value of the share and what we call the share premium. The share premium is whatever you have on top of the initial nominal value. Why do people pay the share premium? Because it could be that they want to participate. There's actual competition for getting those shares. So they're happy to purchase shares above the nominal value because they think they're participating in something valuable. Now, why did I put £2 instead of the £1? The reason was practical is because as I was setting up the company, I was actually purchasing a lot of services. One of them needed to pay immediately. So to pay for the website that I was putting together with the company was above £1. So I wanted to have at least £2 in there initially, just in case it tried to take the money from the bank account very quickly before I had the chance to put any more money in. So I thought, let's put £2 just to be on the safe side. Right? In fact, the initial contribution, this is money that the company takes for itself. The initial contribution, you cannot actually spend. So the amount written on the share, which is the nominal value, and the share premium, whatever people paid in excess to purchase that share, at this initial transaction that the shareholders give the money to the company, stays with the company, and that is protected. This forms what we call the legal capital. So this legal capital is the minimum that needs to stay in the company account at all times. Why? Because supposedly this provides some assurance to creditors that there will always be a little bit of money in the company. Now, what assurance a couple of pounds are going to give you, in fact, is not much. But should you deal with this by putting in more money? So I could have dealt with the initial stages of the formation of my company by putting a lot more in the share premium, so I would be able to pay the website, the email addresses, the virtual office, any initial expenses if I set up like a direct debit for a phone number immediately, Why didn't I pay £1 as the nominal value and then £200 as the premium, so the company would start off with a more significant amount, so you would actually have the money to pay all of this? I could have done it, but this would have been a bad idea, because this would set my legal capital at, say, £201. So the company then would need to retain this at all times. So I would be locking these £200 into this company forever. And in order for the company to be able to give back money, if it trades successfully, it can only give back money in excess of this legal capital. So I would never be able to retrieve my money from this. That's why everybody starts off with the nominal value of the share being as little as possible, usually £1, and the share premium is also relatively modest. So some people use it as a way to have an influx of money initially into the company to set it up, but it's never put at very high levels, because then it disadvantages any repayments if the company wants to give money back, because that money is then locked into the company forever. So that's why I locked £2 into the company. It initially gave me the assurance that if there was any sort of credit check, or if the bank needed to check if it can make the payment, it wouldn't bounce back and it wouldn't create any issues. But I wanted to leave it at that. How did the company get money then to pay all of the stuff? Initially, I made a loan to the company to meet these initial expenses. So the people who do set up a public company need to actually cough up 50,000 when they're putting it in. And they will, because they sell the shares to the public, normally they will have a higher amount of shares. They will not just issue 5 shares, and they will adjust the nominal value and what they expect as a share premium at this initial sale when they're launching in the stock market at a level that meets these initial contributions, and that gives them a bit of breathing space as well. But for a public company, the amounts are going to be a lot larger, and the contribution for the general public is going to be a lot larger. Remember, however, that we're just talking about this initial sale of the shares. Now, I could sell my 1 share to somebody else for £1,000, but that would be money coming back into my pocket. It would not be going to the company. So it will not change anything for the company's legal capital, no matter what. I could be selling for less, really, okay? I could sell this share for 50p to somebody. It doesn't really, I lose money, but it doesn't really make any difference to the company. The company's legal capital is set by this initial nominal value and share premium at this first transaction. So what you need to remember is, when the company is setting up for the first time and is selling its shares to the shareholders for the first time, it needs to think about what the nominal value is going to be and whether they expect any share premium or not. And then that contribution of that package is called the legal capital, and the company will need to retain this for as long as it's operating. How are shareholders rewarded for participating in the company after they became shareholders? Because clearly you paid some money into it, you expect to get something out of it. One way in which you could make money would be to sell the share at a higher value to somebody else who wants to purchase it. This is possible for a private limited company, but it requires the participation of the company in the transaction. If you were in a public company, whether it is listed in a stock market or not, it is easier to just transfer your shares to somebody else who wants to buy it. And the value of that is determined by the market. You will find the person who's willing to give you the highest amount of money, and you will sell it to them. And then, what they do thereafter, you don't care. But for the majority of private limited companies, the shareholding is fixed. It doesn't really change. So how do shareholders in a private limited company actually make money if they never sell the shares? This is done through the payment of dividends. Companies have got the ability once or twice a year to make payments of excess money that they've got to the shareholders to reward them for their participation. How do I get money out of my company? I could hire myself as an employee and pay myself a salary. right? That could be one way. But I would actually need to do this. I cannot get a salary for being a company director. They can compensate my expenses. We started talking about getting a coffee, getting the train ticket, getting a meal during a day in which I'm carrying out company business. So expenses for directors you can refund, but directors don't get a salary. Being a director of a company is a function, it is not a job. So if I wanted a regular payment, the company would need to hire me as an employee and then run payee, so register with HMRC to run payroll, and then pay me through payee. So that's one way of doing it, but this would be rewarding somebody who is actually actively engaged with the company, is already a director or wants to be hired and work for that company. Shareholders normally are the owners of the company. They don't necessarily have to be, they don't have to be involved, and usually they might not be involved if you got a company that contains a larger number of people. The majority of them are likely to be shareholders. They seek to profit. They made an initial contribution, but they don't actually want to be there and do anything. So the way in which you can regularly reward those is by making these dividends payments. So when the company has traded successfully and has made money, then it can choose what it does with this money. How do we know if it has traded successfully? You take out what is the legal capital. So you cannot go below in the company's bank accounts from the initial contributions of the nominal value of the shares and the share premium. This stays always. From that point onwards, you have to look in the company's balance sheet, which is something that we'll see, we'll talk in a different presentation. But a company's balance sheet will have, on the one side, the liabilities, and on the other side, the assets. If you have a positive outcome, this is not just looking at the bank account and whether the bank account has got money, because the balance sheet is dynamic. It's got money that you've got in cash, but it also has invoices that are waiting to be paid. It also has bills that you need to pay. And all of these things could be either short-term liabilities, things that will happen by the end of the month. We need to pay rent, we need to pay energy bills, we need to pay phone bills and all of that stuff. But we're also receiving payments from various invoices for jobs that we've done. But it has also long-term liabilities. It could be that there's repayments on a loan. It could be that there are longer-term financing deals that need to be serviced. Or it could be that we have something that, we get regularly, but we pay every 6 months. So you have a look at this balance sheet. If the overall result is positive, it means that the company has traded successfully. Out of that positive asset base, you've got assets that are liquid, meaning cash in a bank account, that are immediately available. From that liquid part of the assets that is immediately available, the company can then choose whether they give some of that or all of that back to the shareholders. They cannot give money back to the shareholders if it brings them in the negative. So they cannot be giving, they cannot go as low as the legal capital, that they cannot touch. They also cannot go as low as leaving them in the red after they made the distribution. So from available money, you can choose to distribute back to the shareholders. How do you do this? The directors make a recommendation. The general meeting of the shareholders can approve that recommendation for the dividends payment. If it's within those legal boundaries, then this payment can be made. What are the tax implications of these payments? This comes after you have accounted for profits and things. So it means that if the company has traded successfully and it has to pay taxes, right? Taxes are paid on profits, so you will deduct the expenditure and so on. After all this is cleaned up, what you've got, you can make dividend payments after this. But you cannot reduce your tax liability by making dividends payments, right? Otherwise, no company would ever pay any taxes because they would give all the money to the shareholders immediately and say we didn't make any money, right? but it does generate a tax liability for the person receiving it. If you're receiving dividends payments, some part of it is tax-free. It used to be £1,000 a year, now it's dropping down to £500 a year for this tax year. Dividends income above that level will be taxed, but it is not taxed at the normal rates. It's taxed at lower rates. So the threshold that we've got, 20% for basic tax rate payers, 40% for higher rate payers, and then I think it's 50% for a higher band above a certain level. It's lower than this for income that is received through dividends. So you get some benefit. There's some incentive there. Now, why is that? Why is there such an incentive? I've got no idea. It's because the rich people in government, because they make a lot of their money through dividends payments, they decided that you're more worthy if you're making money through doing nothing than if you're doing money through working. So if you're actually working for your money, you pay higher taxes than if you're receiving them as dividends sitting in the back doing absolutely nothing. But dividends payments can be very significant, and they are a very significant source of income for quite a lot of people. I've got an example here that has billions in dividends payments. And you can see that if you look at the financial press on a daily basis and see which companies have announced dividends payments, they can be quite significant. Listed corporations will issue this information in the press, and they will say, British Telecom or something has made a payment on its shares, and its share is worth, say, £8-10. Its share earns 15p, 18p as interest. But since they've got thousands of shares in circulation, if you hold thousands of shares, that can actually make very significant amounts. For a very long time, these investments have outperformed bank interest rates. So you actually get a better return on your investment by having your money invested in stock, and even if you don't sell them and you're just relying on dividends payments, you will do better than having your money in a standard deposit account in a bank. Of course, nowadays with interest rates having gone up, income from investments in banking products is getting a lot better. So that's something to think about. But I think all of us are fortunate enough not to have any excess money, so we don't have to worry about where to invest it. Yes. So this headache is only for the rich people. We are fine. But to come back to my main point, the main way in which people make money out of being shareholders is through their dividends payments in private limited companies. In publicly listed companies, they usually make money by transacting and selling them to somebody else. Okay, let's see this through the form of an example. So if we've got these people, Yorgos and George, and they've set up their company, if the company had 200 shares valued at £1 each, that would be the nominal value. This was initially issued at £1.50, right? So £1 was the nominal value, 50p was the share premium. This will make the company's share capital as having 200 and an extra 100 in this share premium account. So the legal capital now becomes 300. Yeah? This is the amount of money that the company cannot leave. It always needs to stay with the company. If they wanted to make a dividends payment of £10 per share, because they've been trading successfully, how much money do they need to have in available assets before they make that dividends payment? They do need to have 320, okay? Because why is it 320? Because the 300 they cannot touch. So if they want to give back 10p for every share that they've got available and they've got 200 shares, then they need to have an additional £20 before they make that distribution. So if you had set up your company with a very high price as the nominal price of the share, or you had a very significant share premium when you issued them, then you would need to have a lot of money available before you're able to make distributions to your shareholders. So it would actually put you at disadvantage. You can change it, yes, we're gonna see that shortly, but it's a process that you need to go through, which means it's a bad idea. But if you don't know this, if you're going through the steps to set up a process, if you use the sort of facilitator electronically like I did, and it says how much money would you like your shares to be, or if it's one share, how much money would you like the share to be, it could be that you think, well, let's put it at £1,000, because that way I give £1,000 to the company, and with these £1,000, they can actually cover all their initial expenses for the first year that I'm running it. But actually, this would be a mistake, because you would have put £1,000 in the non-distributable reserve, so they wouldn't be able to do much with these £1,000. And certainly, you would have locked £1,000 into this business forever. From the money that they've got available, right, after you kind of cleared out all the liabilities, the leftover money in the bank account needs to be at least 20 before they can make that distribution. Actually, it needs to be 320, because the 300 they cannot spend, so it needs to be a 20 on top of that to be able to give it back. You cannot fiddle with this legal capital. This comes under the label of capital maintenance. So you're going to find in your textbooks areas that they talk about capital maintenance. This is where they attempt to explain all these rules as to how do you get money in to the company, and then once you get it in, what does this mean in terms of getting things in and out? It isn't very complicated. It just means that you need to be organized. So from an operational point of view, the only thing you need to do is have a spreadsheet where you kind of write everything. This is all the money that came in and the dates that it came in, and have an explanation of what it is. And then this is all the money that's come out and when it came out and why it's coming out. And it is as simple as that. Your problem might come from lack of record keeping. Because when you come to do your tax accounts at the end of the year and you need to add all these things up, if you don't know where anything is and you have to figure it out just by going through the bank statement, you might get stuck. It could be that some stuff didn't pass through the bank statement. For instance, promotion expenses, amounts of money that you needed to pay before the company was even set up, say for a virtual office or something like this, will not feature in the bank account because it was money that got spent before you set up the bank account. So you need to have an external spreadsheet where you keep a record of all this information, so then you can actually use it to produce your tax documents, or if challenged by somebody, you can actually demonstrate what's going on. If there is anything that is lacking an explanation, you will get in trouble. And in practical terms, what will get you in trouble is your bank. So HMRC or, the regulators or whatever, or, the Metropolitan Police doesn't really have the time or the inclination to look at minor businesses and minor transactions. Now, okay, clearly if, some uncle of yours gets excited that you set up a company and sends you £60,000, then that might ring an alarm bell somewhere. But trouble is not going to come from the revenue. These guys don't even care when you try and tell them stuff. It's like you try and tell them, I owe you money and I don't understand, like you asked me to pay less than what I owe you, what am I going to do with the rest? And they're like, don't worry about it. Somebody at some point is going to send you an email, and then they send a letter saying, it's like from 3 years ago, from that self-assessment, you still owe us money. Would like you to pay it? It's like, yes, I would like to pay it 3 years ago. What took you so long? Because they don't care. And clearly the police doesn't care about anything unless it's kind of major criminality. But the bank will care. And what the bank will do, because they're so worried about getting in trouble, because obviously their interaction with the authorities is very different, if there's anything that looks unexplainable into your accounts, they will say, we think there's something here, we will investigate to see what's going on. And they might take forever, or while they're investigating, if they ask you for information and you have difficulty producing this documentation, like your uncle sent you £6,000 and you cannot actually tell them why, then they might freeze your account. And if they do this while they're investigating, you cannot use your account, you cannot use your bank card. Effectively, they've cut you out of your business. We had this discussion with somebody recently. This exact thing happened to them, and it's very unpleasant, right? And I'm not suggesting anybody has done anything wrong, but that's how weaknesses in your record keeping can become a problem. a legitimate question could be, what happens if somebody got it wrong? What happens if at that initial stage you didn't know about all this and you set it too high? Yes, you can change stuff. For instance, if the people that we were using as an example, Yorgos and George, initially raised £1 million by a share issue, if they haven't done very well, and now the assets that they've got available on top of the liabilities are only 500,000, it means they cannot actually pay any dividends. Because if their legal capital is set at $1 million, they need to exceed that $1 million in available money before they can return any profits to the shareholders. If they've been consistently operating not according to their expectation, they're never going to be able to make a return to shareholders. There are companies that have been operating at a loss forever. Ocado, for instance, the supermarket, was famous for being loss-making for ages. I think it's only when we hit the pandemic that they managed to, shortly before the pandemic, that they attained the profit, and then they did quite well for obvious reasons. It's not necessarily a problem to operate at a loss, because you could make up the money by borrowing if people are willing to give you money, or you bring more investors in to cover the losses. But if the legal capital prevents you from making distributions to the shareholders, then you cannot reward the people who've stayed with you up until some indeterminate future point that you actually managed to do better. So what you can do is reduce the company's capital, which means that you can bring it lower to a more realistic level, which releases available money that then, if you trade successfully above that level, you can return it to the shareholders. So the way this is done is that you need a special resolution of the general meeting, and then if you obtain that resolution that is asking for the reduction in capital, then you need to apply to the court to get this approved. The reason why you need to go through the court and you cannot do this yourself is because this obviously affects creditors' interests. As we said, the legal capital is the minimum that needs to be there to kind of satisfy people if the company goes bust. Now, in my case, the £2 are not going to help anybody, but in this case, it would be significant if they've got $1 million as their legal capital. So the court needs to be involved in any decision to reduce that. If a special resolution, by the way, means that it is 3/4 of the members that want to do something, right? You don't need a majority. You don't need a simple majority, which be more than half. You don't need 100% agreement, but you need 3/4 of the shareholders being in agreement to do something. Okay, right. So if you do this and the court accepts, you can reduce the capital, and then you'll be able to make distributions a little bit more easily. It would have been easier on everybody if you had thought about this at the beginning and you hadn't actually issued the shares at that significant value. Can you, if you want to bring more people in, you want to bring more shareholders in, can the company give people a loan to purchase shares in order to entice more people to come in? It sounds like a dodgy idea. It is possible for private limited companies, because if the company has got excess funds, it can decide to do a bunch of things with these excess funds. It could return them to the shareholders, it can reinvest them, or it can invest them in other things external to the company. Making a loan to somebody is a way of investing that money. Now, if that somebody uses the loan to purchase shares in the company further, then that could be part of a scheme to bring in additional shareholders. It shouldn't be perceived as inappropriate. But if in a private limited company a decision is made to give a loan, then it needs to go through the proper channels and have the proper authorizations. And if the person receiving the loan is already a shareholder or even worse, a director, then there are some very careful checks and balances to make sure that this is done on commercial terms and for the proper purposes, and is not just a kind of sideways gift to somebody. There is, however, a prohibition in providing financial assistance to purchase shares to public companies. Because it would be considered that this, it would mess up with people's incentives in investing in public companies if a public company was actually subsidizing the purchase of its own shares. If the shares are listed in the stock market, their value is determined by people buying and selling. If some of the people buying are getting the assistance of the company to be able to do this, then it will affect the valuation in the stock market. That's why this is not allowed for public companies. And when we're saying about giving financial assistance, the company, if for public companies, the company cannot give it directly, but it can also cannot give it to other people to pass on to other people. So the example that we've got here is that if we had a public company, so if Yorgos and George set up their company as public, and a bank is giving a loan to somebody who intends to purchase shares in that company, and the company itself tries to guarantee that loan, it will be caught by the rules of providing financial assistance. So the company itself cannot give the money to somebody to purchase its own shares. If it's a parent subsidiary structure, another subsidiary in the group cannot give the money because it's part of the same group, so it's caught by the same prohibition. And nobody can provide a guarantee to cover that liability if it involves the same people. So some kind of clever scheme, let's put somebody else's name on it to achieve the same effect, is not going to work. But remember, these are prohibitions that have to do with public companies because it messes up valuations for the shares of public companies, whether in the stock market or not, but usually in the stock market. If it's private companies, then the rules are a little bit more loose. And then what you need to worry about are permissions that you're doing this appropriately and you're not giving some sort of inappropriate benefit to somebody who's already connected and all of that stuff.